Hi, Dave Hazeldine here, CEO at The Updated Investor. For over about the next 30 minutes, I'm going to introduce you to the Updated Investor's Financial Dashboard. It's something I'm incredibly proud to be bringing to you because I know it has the potential to make a huge difference to your ability to secure your family's financial future. But before I can get into it, a couple of words. In this day and age, it's impossible to get away from the lawyers. The dashboard doesn't constitute financial advice. So before making any financial or investment decisions based on any of the information within the dashboard, you should consult with your financial advisors and obtain personalised financial and taxation advice. The Updated Investor's Financial Dashboard has been developed and is being promoted by the Updated Investor and has not been approved by or endorsed by AMP or AMP Financial Planning. It's a tool for tracking your financial progress and whether or not the financial strategies you are employing are working. Whilst I urge you to read the disclaimers and assumptions within the dashboard when you receive access to it, I don't want to get bogged down with all the legal stuff, so let's get into it. I've been in the investment industry now for 25 years, and I've been advising clients from those struggling to keep a roof over their head to those with multi-million-dollar investment portfolios for well over 15 years. Over that time, it's always been my personal goal to make a real difference to the ability of clients and their families to secure their financial security. Let's face it, life is short, and it's way too short to spend it worrying about how you're going to pay for the next electricity bill, regardless of what stage of life you're at. So what is financial security? I like to keep it simple. So my definition of financial security is simply to have enough money coming in from passive sources to keep a roof over your head, food on the table, and to be enjoying a reasonable lifestyle. It's on the day on which all of this happens, as corny as it sounds, I like to call your Financial Freedom Day. If you own a business, it means that business can survive without you being around for extended periods, or if you're like the majority of Australians, it will mean you don't have to go to work if you decide not to, because you've got enough money invested, or enough investments if you like, to provide enough income to see you and your partner's days out. What I've learnt from observing and advising clients who have made it to their Financial Freedom Day is that they all share similar traits. The way they earn money varies incredibly. Some have been business owners, whilst others are salary and wage earners. Some were what you might say overachievers, whilst others you might call very average people. There is no pattern in how they earn their money, but the way they think about it, whether by accident or design, is very similar regardless of their background. It explains why so few fortunes survive a second generation and why people after a lottery win or a large inheritance find themselves after a short time back in the same financial position they were in before the windfall. The ability to hold on to money doesn't seem to matter if you're the smartest, or if you had the best income, or if you made the best investments, or if you were just plain lucky. It does, however, have everything to do with learning and adopting good money traits. What I'm trying to say is that everyone can be financially successful provided you are prepared to develop good money traits over your working life. This is what the dashboard does. It gives you the tools to develop good money management traits. The good money management traits have been the same probably since the invention of money. So it's incredible to think that less than 1 in 5 Australians will get to their Financial Freedom Day by age 65. The rest will be reliant on the government to some degree to fund their retirement, or worse still, some will have no option but to remain in the workforce just to put food on the table. Remember, compulsory superannuation was brought in to reduce the social security burden on the taxpayer, because the government simply won't be able to pay it at current levels as the population ages and more people hit retirement age. If you are planning to be reliant on the age pension at retirement, I'm seriously worried about the quality of life you're likely to have, especially if retirement is more than 20 years away. The reality is, getting to your financial freedom day is really very achievable for most Australians, especially considering most of us are receiving at least 9% compulsory superannuation. It does, however, mean leaving less to chance by taking a slightly more active interest in your financial destiny. To be clear, it doesn't mean doing without, but it does mean being aware what you are thinking in relation to money and being aware what you do with money when it does come your way. It will probably mean unlearning a lot of the marketing bullshit we have all been subjected to, which has been disguised as well-intentioned information. That's what the updated Investors Financial Dashboard is all about. I've taken those 25 years of observing what works and what doesn't, then incorporated the tools to help people develop these traits within an easy-to-use financial dashboard. Anyone who can use a computer is able to easily set up their own dashboard and then quickly update their situation as frequently as they want to. It allows you to track your progress and provides you and your professional advisors feedback to identify risks and opportunities in your financial situation. It is deceptively simple, but along with your ability to earn an income, has the potential to secure your family's financial future. So let's take a closer look at the dashboard. Okay, what I've set up here is a brand new user. So what you're seeing is exactly what you will see when you get your username and password. So here we go. I set it up as example 1. Type in the password. Be good if I could type. And hit the button. We go in. This is the first page you'll see. There's nothing here at the moment worth really looking at because we haven't entered any information, and this main page is where you'll see the tracker and all the dashboard results coming in a graphical format. The next tab down, and it's easy to navigate just by crunching these tabs on the left hand side here. The first one is information disclaimers. You can't get away from them. These are what I was referring to earlier in the presentation. Worth reading at least once, and you may want to refer back to them even more often. There is a message board in here. What it'll do is if I'm sending out a message like an update to the system or wanting to have a chat with you personally or whatever, I can send a message through to you as individuals or to every user that's actually listed using the dashboard. If there's a message there, what you'll see is on this main page up here in this area is an alert alerting you to the fact that there is a message there. The results in detail page, this is where it all starts to come back in. We got an investment property in there. How did that happen? We'll have a look at that. There shouldn't be an investment property in there. It should be completely blank. I'll have to have a look at that. Maybe I was playing with this one earlier and forgot about it. But anyway, we'll get to that. What we've got then is the personal details page. Now this page sets out a whole stack of information, and not a lot of it is required, but there's some fields which are certainly required. I'll just go through an example just to run through just how quickly and easily we can set it up. Let's say this guy's name is James. Again, it'd be good if I could type. His last name, let's call him Smith, and he prefers to be called Jim. Her name, and they're married, why not? It's Joyce Smith again. Oops. It's just telling me I haven't entered a required field. Preferred name, she likes to be called Joy. Now, without getting into all this sorts of detail, now bear in mind too that a lot of this has been set up so you can interact with your advisor. If I'm the advisor, I'll have access to your information that you're putting in here. You may want to nominate your own advisor, and we can certainly allow for that to happen as well. So that if you're using Happy Joe, Happy Financial Planners, we can set them up so that they can view your details if you want them to. So a lot of the information here is so that you can have that feedback with your advisor. So let's call this guy's date of birth the 17th of April 1966. Her date of birth, and now these are required fields because of lots of calculations that are going on in the background. And they're married. So just to go through it, we can put in there whether you've got dependents, whether your dependents have any special needs, for example, whether you've got a planned retirement date or not. Terrific. Whether you've got any hobbies or interests. This is the standard sort of fact-find stuff that I like to get from clients, so I thought I'd whack it in here. Whether you got whether you're a smoker or a non-smoker, and obviously those sorts of questions relate to insurance. Employment status, whether you're employed and on what basis, whether you're a business owner, whether you're in a partnership. These can all have financial planning type implications. Who your employer is. Don't worry about putting your tax file number in here. That was just the standard fact find information. But things like estate planning. Do you have a will? Was it last reviewed? These are all the things that your financial advisor should be keeping tabs on. And this is a great way of you being able to interact and update your information with your advisor, and your advisor being able to sort of prompt you and coach you as a financial coach, as I think all good financial planners should. Your accountant's name, whether your advisor has authority to contact them, whether you've got a company, whether you've got a trust, whether you've got self-managed super fund. You can put all that information in here, but none of that is actually required to make the dashboard work. What is required is this as at date. This is the as at date you first start to enter your information, and pick a past date. Maybe make it the 1st of July, first day of the financial year that you're entering your data in. This cost of living is also required, and whilst it's not required to be 100% accurate, it's a good idea to be realistic, and it'll become obvious as to why. In this case, most couples have an average cost of living of about $40,000. It's pretty basic cost of living, but it's about average, rule of thumb. So we'll use that as the cost of living in this. I'll go through this fairly quickly because I don't want to take up too much of everybody's time, and it will be much better if people get in here and play with it for themselves. It is necessary to hit the submit button after every time throughout the system. If you see a submit button, it means that basically you need to, every time you change information, to hit that submit button. Commits the new information to the database and updates the database. So we've got personal details. The next thing you need to enter is your salary, or this is the sort of information you generally find on your payslip, and what we're looking for is annual figures here. So let's say he's got an annual salary of $62,400. She's got an annual salary of $31,200. He reckons he's going to get a bonus, and this is estimate. What this is going to do is provide a future cash flow estimate. So this is all estimate, but again, just like the cost of living, the closer you can estimate it to reality, the better the information will be that you get out of the dashboard. Garbage in, garbage out. So she's not going to get it. She doesn't think she'll be getting a bonus this year. On his pay slips, he gets paid monthly, and he knows that his employer is actually deducting about $13,000 worth of tax each year, PAYG tax. Hers is deducting about $5,000 worth of tax each year. He's also they're both actually making, for the sake of this example, $1,000 a year salary sacrifice contributions. If you're getting other salary sacrifice items like cars or FBT items generally, or if you've got self-employed income, this would be the place to put it. Okay, so here we go. We'll just bung that in there, and it figures out, what your cash flow situation is, and it'll actually, and this is where, with that much information, we can start to see what's going on in the results in detail. It's brought that salary and bonuses in. Forget this net rental figure here for a second, we'll get to that in a second, but you can see, and it's had a guesstimate at what the tax refund or tax payable will be. It's whacked in the cost of living that we put in from the personal details page in here, and it's brought in the PAYG tax. So we're starting to develop a cash flow statement. This is called. This is your income, this is your expenses. So we'll just keep going. Now this couple also have a bank account, and they keep it for emergencies. And here you go, bank account, debentures, or emergency fund. If you have an emergency fund, use this field here. It's one of the pet things that I like to have. I like to think most of my clients have a 6-month cost of living emergency fund. And funnily enough, these guys do. And that's in that's a savings maximizer. And it is with ING, and it's in joint names, and it is for $20,000, and they're getting, say, 5% on it. Well, that's only $2,000. So there's that submit button again. Let's hit that. You'll notice that it brings up, whether the bank account's in his name, her name, or jointly. You just got to pick which one is appropriate. Away you go. Hit the submit button, and it goes back to the summary page here. Now if you go back to the results in details, we can see now we've got some interest coming into the cash flow statement for both of them, and there it is, emergency fund, $10,000 in the what you own, or the asset side of the ledger. Let's look at the real property page now. Now I was playing with this one earlier, but and what I did was put in a rental property, but now let's add their family home. So they got a principal place of residence, and if it was a rental property, it would be other. The description is 123 Test Street, let's say, or family home, or whatever you want to call it. The value is, let's say, $600,000. Oops. And it is in both their names, and there's no income because it's a family home. That's where they're living. They're not charging anybody any rent to live there, so the property is not actually producing an income. Let's hit submit, and we can see now we've got two properties in there, both for $600,000 as one, as luck would have it. One's a family home and one's a rental property. The rental property's got a yield of 4%, which equates to $24,000, which is why, there you go, which is why in the results in detail page we're getting rentals coming in at $12,000 each. Okay, so you can start to see how you can quickly build up your financial picture, if you like. There's also options there to add managed funds if you own managed funds, and shares. And let's just add a share very quickly. Let's say they're Joy's shares, they're BHP's that she inherited. Let's, for the sake of the example, let's say the number of shares is 1,000. What's BHP share price? I couldn't even tell you. Let's use CBA's because I know what CBA's share price is. Their share price is about $47 at the moment. Let's call that today. It's the day I'm doing this is the 30th of November. It'll automatically calculate the value based on the number of shares and the share price, but we do need to put an estimated income. CBA's income at the moment is probably about a 5% dividend yield. It's about 100% franked, Now, if you own shares, these are numbers you're probably fairly familiar with. It'll automatically gross up the dividend, and we can hit submit. And if we go back in there, you'll see that it's calculated the income and the franked amount and the unfranked amount. If there was any unfranked amount, that'd appear there as well. It has all those numbers get taken into consideration in the tax calculation. That's how, how easy and deceptively simple this system is. It's easy to enter the information, but there's a fair bit going on in the background. So now we've got interest, and she's got $2,350,000 worth of dividends coming in. Okay. Now I'll just go to liabilities. I'll leave superannuation for a second. Now liabilities, let's say, for example, the liabilities here, they've got a home loan, it's a P&I loan, it's in both names, the lenders, let's say Westpac, the value is 140. It's not a real life example, only the names have been changed to protect the innocent. So anyway, they're paying $1,500 a month on that, and that use not 150, 1,500. Use the amount they're actually paying per month, not the minimum that you have to pay, but the actual amount that you pay per month on the mortgage. It'll be fed into the cash flow statement correctly. They're paying 7% interest, and it's secured by the house. Let's submit that, and what it will do is show how much interest is being paid out of that $1,500 a month. It's a rough guesstimate because the way banks always calculate their interest is slightly different. But what we're trying to get to is a ballpark area in which ballpark we're playing in. He also has a line of credit which is secured by the house. He thought he might get into some speculative shares, and guess what? He lost it all. He wasn't very popular with Joy, and it's a line of credit attached to the home loan. It's worth $100,000, but it's non-deductible. How many zeros did I stick in there? $100,000. The payment that he's making on that is $583, and it's 7%, hopefully, and that's secured by the house as well. With a bit of luck, we'll see that coming through, and because he lost it all, it's no longer tax deductible. Oh, don't tell me we've gone on a go slow. There you go, 583. It's interest only, line of credit. Now, because they've got and you can add more lines to this, as many as you need. You're not restricted to those. These just come up by way of an example in the system. You can have a margin loan or an investment loan, but you need to differentiate between deductible and non-deductible liabilities. Obviously, deductible liabilities, the interest comes off your tax. So they've got an investment loan, principal and interest, it's in joint names, the lender's Westpac again. Let's call and they borrowed the full amount for the investment property, let's say. And the repayment per month, I'm not sure about this one, but the interest rate is still 7% because it's actually secured by, and this is information your financial planner is going to be interested in, the house and rental prop, let's say. Let's hit submit, and we haven't put a repayment per month because we're only paying interest only on it, and we want to find they're paying $3,500 interest on that a month. This is what the system's calculated it at, but you should put real figures in, obviously. 3,500. Be good if I could type, wouldn't it? And let's hit submit. There you go. So this is a breakup of how it's breaking up the deductible and the non-deductible between him and her. It's often, they'll have credit cards in his name or her name. You put all that in there, put on how much you're actually paying per month and the monthly balance. Ideally, you're updating this monthly, and you're updating, hopefully the loan values are coming down, certainly in the non-deductible area first. But I'm starting to verge on financial advice here, which I can't do unless you actually seek it from me personally, but you sort of get the picture of what I'm trying to say there. Okay, moving right along, superannuation. I don't want to talk too much double Dutch, but you hopefully get the impression of what I'm saying. Okay, superannuation. Same story, we can go in and add as many superannuation funds as you've got. Unfortunately, most people in Australia have got more than one. But to keep things simple, we'll say he's only got one. This is Jim's, we'll start off with. Has he got a binding nomination? Don't want to get into that, but let's assume he has. If he has one, it's important that we know what date that binding nomination was made at. It will provide a prompt in future years when that binding nomination has to be reviewed. Let's call his superannuation is with BT Employer. Ugh, cannot type. The balance of his superannuation is, let me look it up, I think it's $100,000. Yes, it is. And that was basically on the 31st of July when he got the last statement, let's say, for the sake of the example. Does that look right? $100,000, yes. And now for her. She doesn't have a binding nomination. Probably should need to look at that. It's her name, and that's it might be in an SMSF. It may be with MLC, MasterKey, for the sake of the example. And her balance is $60,000, and that was on. Probably should have put a date in there. Let's go there and put a date in there so we can keep track of it. Again, that was on the 31st of July when she got her end of year statement. Now this is where it gets really cool. This is something I'm very proud of. Let's put a retirement. This is a superannuation projection. Most people have no idea of how much they're going to have in superannuation when they retire, and whether it'll go anywhere near being enough. This attempts to give people an idea about that. So most research houses will say for average balanced superannuation, average returns over the long period for superannuation is about 8.5%. So let's use 8.5%, and I would encourage everybody to put 8.5% in that box, just as a rule of thumb, just as a yardstick to give us an indication of what your superannuation might be worth. Inflation, the average at the moment is about 3%, so we can stick inflation in there at 3%. It's automatically brought the superannuation balances in that we just entered, $100,000 and $60,000. Now we're happy with all of that, so let's hit submit. What it does is say, okay, at age 65, today's cost of living of $40,000 is going to be worth about $72,000 after adjusting for inflation of 3%. We got 20 years to retirement. To fund that amount as a rough ballpark figure, and it is a rough ballpark figure. Look, economists can't predict what's going to happen 12 months out. The most highly paid economists in Australia can't predict what's going to happen 12 months out. So this is just a rough estimate, a yardstick of whether or not your superannuation is going to be remotely close to being able to support your cost of living in retirement. So basically what we need to see at the end of the 20 years is a number of about 849,000. What this does, and you can scroll all through this and follow the projections through yourself, is say that the estimated balance at retirement is actually $1.2 million. Bearing in mind of salary, getting SG on that, it automatically calculates the SG contribution. There it is there. We're salary sacrificing $2,000. Remember, we put that in the income part of the data entry. If you've got other taxable contributions, maybe you've sold a small business and you want to see what effect that has. Maybe your after-tax contributions, not their non-concessional contributions, you might be putting $1,000 in to get the government co-contribution. You can put that in there. Less insurance premiums. This is a big one. Most people don't appreciate, but their superannuation is actually being hit for insurance. Life insurance, income protection insurance, and TPD insurance. Don't want to get into that at the moment, but that has an effect on how much money will be left in superannuation at retirement. You need to put that in there. So let's say, okay, there's $1,000 in insurance premiums coming out, and we're putting $1,000 in. It won't affect the projection, but you'll be able to see what happens when we hit the submit button. There you go. It's being inflated up for inflation as part of the projection, and then so at the end of year one, we've now got $180,000 in superannuation. That becomes the opening balance in year two, etc., etc. So that basically, if we've got 1.2 and we only need 849,000, there's a surplus potentially at retirement of $371,000. So as far as superannuation goes, this couple are pretty much on track. Cool. So that's all good. Okay, we've entered the liabilities, so let's go back to the results and details page and see how all of this flows in. Because we've now got tax deductible expenditure, or tax deductible interest I should say, there it is, 21,000 each on the investment property. They're actually getting tax refunds now, where before we put that liability in they weren't, because it was all taxable income with no deductions. So between the two of them, life is pretty good. They've got the family home, you got the superannuation, they got an emergency fund, she's got some shares and the investment property each. They got $1.4 million worth of assets, $840,000 worth of liabilities. Their income, so this starts to develop. Some of this will make sense, some of it won't make a lot of sense, and some of it's here to provide your advisor with information. Net income or expenses, they're actually saving $7,500 a year, but are in an after cash sense, because they're paying off principal off their loans. Their bank account's going to be minus $443 at the end of 12 months, potentially. So you can start to see why it's pretty good to actually make a fair estimate at this. And you and your advisor will be able to tell at the end of 12 months whether that's been realistic or not, depending on whether the bank account balances, because that's where you fund the surplus or deficits from. If your bank account balance has gone down by more than $443 at the end of 12 months, it means you're actually spending more than $40,000 a year. So you can start to fine-tune it after a while. Hoping I'm not dwelling on this too much and not boring people too much, but it gives people a really good sense of what's going on. Look, I say targeted net worth excluding family home. Why exclude the family home from the net worth is you cannot use the family home to put food on the table. Remember, keep roof over your head, food on the table, and enjoying a reasonable sort of lifestyle. So I exclude it from your net worth because it can't actually it can't put food on the table. It can't add to a reasonable sort of lifestyle, except that you don't have to live on the street. But you know what I'm trying to say there. Cash coverage, that's a stat that says, okay, 2.2 months is when they would run out of cash if their income stopped. Their LVR, loan to value ratio, is 66%. Some people might get interested in this, other people won't be so interested in this. This area is, and I should just say that this area is projected sort of 12 months in advance. this area, what you own and what you owe, is accurate depending on how often you update your assets and liabilities and how accurately you do it. Okay, now we get into the really cool bit. This is where we can go back to the main page and say, okay, sorry, silly me, I should, having satisfied ourselves that we're happy with all that and that is a reasonable replication of our actual situation, we can hit submit, and that commits all that information back to the database once more. Now we can go back to the main page. Now let's say, for example, we updated all this information at the 31st of October. Let's hit commit, and this is the really cool bit. And why hasn't that worked? Yeah, there you go. Yeah, it is actually working. I just did a bit of a freak out and decided that I needed to check it, and I've actually pushed it 3 times. But you can see what is happening here. It's producing a graph. It's got net assets, which is there, your baseline of financial security, which I'll talk more about in a minute, your assets and liabilities are very close to one another. So that you've got $827,000 worth of assets and $840,000 worth of debt. Net assets are minus because, as I said, I exclude your family home from this exercise. The reason being, you can't cut the corner off it to put food on the table. So it's more of a lifestyle asset than a financial asset. Don't want to spend too much time on it, but you can have a chat to your advisor about that and why that logic, I've employed that logic. Okay, that doesn't make so much sense, but let's say you go through and update all your information and basically nothing's changed. The liability balances are the same, your bank account balances are the same, cost of living is the same, etc. Your superannuation balances haven't moved. It's a bit strange in this day and age, but let's say you haven't needed, and the CBA shares haven't gone anywhere. Just for the sake of the example, and we're going to update it again at the 30th of November. Now what we've got is some trend lines happening, and this will update every time you update, and that's why it's called a net worth tracker. I'll talk a bit more about this baseline of financial security, or the BLFS. This provides a yardstick, but just briefly, it provides a yardstick as to whether you're on track to be able to get to your financial freedom day. Your baseline of financial security is, if you're below that level, you need to do more work to get to it, because if you're on the line, chances are you will get to your to your financial freedom day by, let's say, age 65. If you're below that line, you're going to have to work hard to get to it, or you may not get to it. If you're above that line, you will definitely, well, I won't say definitely because I can't guarantee anything, really, can I? Let's be honest about it. But you get the idea. If you're above the line, you've got options. If you're below the line, you need to work harder. And that's what this net assets is saying, and this is what makes this particular dashboard so powerful. It provides this. I'll talk more about this base level of financial security in just a sec. But there you have the financial dashboard in a nutshell. As I said, it's there so that your financial advisor can look at it. It's there so that you can update it, and your financial advisor, you know, if you're talking to him about it, he can also update it to give you back the information that you can view online at any time. It's a bit like a diagnostic tool. So your financial advisor, in medical terms, if he was a general practitioner, he could send you off and get tests done, and the diagnostic, and look at those diagnostic results and talk to you about those diagnostic results with you. That's what this is a bit of a diagnostic tool. It's one way of perhaps looking at it. So alright, let's log out. Easy to log out, just hit the log out button. So there it goes, and we go back to the login screen. You go off and do whatever it is you want to do. So I'll go back to the presentation, wherever that is. This is the last one we were looking at, wasn't it? And I thought I'd show you just something that, you know, what you might expect to see on the dashboard or the tracker over time. And this is baseline financial security, and this guy actually manages to get above it. It would be his net assets. As the debt goes down, the net assets go down, and his assets are growing in value too. So because he's got no assets at some point in time, no liabilities, no debt, his net asset actually becomes the assets line and goes above the base level of financial security. Okay, so let's talk a bit more about the base level of financial security. And this is something that, you know, going back and talking about what rich people do. Rich people are very aware of their base level of financial security. They know how much they need to have invested at any particular point in time to put food on the table, keep a roof over their head, and to be enjoying a reasonable sort of lifestyle. This is how the rich get richer, and this is why people who survive, fortunes that survive second generation, explain this to that next generation, so that the next generation don't risk their base level of financial assets. So basically what we can tell, this is that line, the base level of financial security line on that graph that we're talking about. We know what your assets and liabilities are and where they are today. Let's say they're there at 10%, and you need to get to 100% to get to your financial freedom day. So over 20 years, let's say for the sake of this example, we know mathematically how much you need to put in each year to get to that level of assets, given an assumed earnings rate and an assumed contribution per year, let's say, for the sake of this example. So we can calculate your base level of financial security, and that's what the dashboard does. One of the main functions of the dashboard is to say, okay, whether you're under or over. If you're under, we need to change something to get you back onto this line. If you're over, we can say, okay, because you're over, we can either move the base level of financial security up and retire early, or we can risk, and this is what I mean about the rich getting richer, we can risk and take greater risks in search of bigger returns of the amount in excess of your base level of financial security, knowing that in a worst case scenario, that if your base level of financial security, that if those assets in excess of your base level of financial security disappear because you've taken on extra risk, all you're doing is going back down to your base level of financial security. You're not going to risk getting to your financial freedom day. I hope that makes a bit of sense. More than welcome anybody who listens to this to give me a call, and I'll take some more time to explain that better. But in the interest of time, I don't want to hang around and keep people waiting too long. I more would encourage you to get on, send me an email, get onto the financial dashboard and get started with it. So it's really that easy to take control of your financial future. It's deceptively simple, the financial dashboard, but there's a whole lot in there that will make it easier for you to get to your financial freedom day. So along with your access to the financial dashboard, you'll also get access to me or another advisor for at least an hour, just to get you started and get you thinking in the right way in relation to securing your financial future. Remember what I said, getting to your financial future is not about being lucky, it's not about having the best job or making the best investments, it's setting up these good money management traits, and that's what the dashboard does. It's so deceptively simple, but it is incredibly powerful. So I'm wanting to test this with as many people as quickly as I can. So along with clients, which will the dashboard will always be free for the next 3 months at least, I say at least, I'm making it free to anybody who wants to give it a go. All I'm asking is that you update it at least once a month for the next 3 months, and then what I'll do is for everybody who's on it, I will actually send to you an online survey to answer some questions about how easy it was to use, what was good about it, what was bad about it, what could be improved, etc. So in the meantime, but if you've got any questions or comments, I'd really appreciate hearing from you. Send me an email, jump on the phone, but don't forget to get started and do it soon. Christmas coming up, now's as good a time as any. This is not a way to judge or what you're doing. It's up to you to take away from the dashboard whatever you want to take away from it and implement as much as you want to implement. It's 25 years worth of experience in financial services all in one place, and I really do urge you to give it a good look and to give it a go for a while, and give me that feedback. So if I don't speak to you in the meantime, have a really great Christmas and enjoy the dashboard. Thanks for listening to this presentation, and bye for now.